It's deja vu all over again with Lululemon stock because just around last year, I did a video around this same time saying, is Lululemon trading around a bottom? I mean, the valuation seemed kind of juicy given their growth and prospects. And subsequently, since that video, Lululemon has largely, it's been on a bit of a wild ride. At one point, it was up around 70%. So it was far out, exceeding the US indices since I made that video. And then just today, you could see it's had a drop. It's falling around 20% in response to its latest earnings, its first quarter earnings. And the first quarter earnings headline figures don't look that bad. You're seeing 7% revenue growth, around 2% EPS growth. So that means you're having some margin pressure resulting in lower earnings versus revenue growth. However, their growth is broad-based when you see that it's spread across women's apparel growing 7%, and they have accessories and men's apparel growing even faster at 8%. So you might look at these figures and say, well, why is it declining? What is going on with Lululemon? So we're going to talk about, I think, the key reasons why the stock is getting sold off in response to today's earnings. What are the top concerns investors have? And then towards the end of the video, I will share my personal take, thinking about the valuation and sort of how it goes through my own checklist, because I have the same checklist, whether or not it's a microcap company or a $1 trillion company. You're running the same process over and over again, trying to find these unrivaled sort of setups, unrivaled companies. If you enjoy educational investment videos, please make a point of hitting that thumbs up, hit that subscribe button. My name is Daniel. So let's continue with what's going on with Lulu. So the headline figures look pretty good, but I think you always need to go a step further to analyze what's actually going on with this business. So as I already said, revenue was up around 7%, and you can see it was spread out across various different regions, with China being a real powerhouse in the business, up around 21%, the rest of the world up 16%. So that's driving 19% international growth. That is great. But looking at the Americas business, particularly United States and Canada, that is a different story, and it's even worse when you look at comparable store sales. So that means you're getting comparable store sales versus the revenue figure. One says, what if you were to just look at the stores that have been open for this time period? They also include their e-commerce sales. So what if you get no benefit from opening new stores, driving that revenue? And what if then what if you just put everything in it? So new stores and existing legacy stores. And the existing plus new, that's revenue. Comparable does not include the new stores. And when you're looking at the more mature base of stores, the comparable store sales, America's actually declined by 2%. And that is a red flag to me, because it does suggest that Lululemon has been losing market share in the US. I mean, there's other theories that go around, like, hey, maybe there was demand pull forward during COVID, and then people, because people said, hey, I just want to wear comfortable clothing. I don't, so you had this big surge in demand a few years ago, and maybe now you're going in the opposite direction. I just would be very surprised if the fundamental market is flat or not growing a couple percent. And I personally suspect that it is positive, that the underlying market is growing a bit. So to put in a negative 2% does reflect, I'd say, competitive pressures or some dynamic where they're possibly losing share in the Americas on a comparable store basis. I think that is a red flag that investors are looking at. Another, key reason why the stock is selling off is because management had to lower their outlook. This is not, a sign that investors like to see. I personally, I called out to my subscribers a health insurance company that I recently was buying, where you have the CEO and he makes a point of saying, look, my goal is to underpromise and overdeliver. And that's that. He's built a reputation and track record for that. And that's the type of management that I want to align with. Whereas when you have something where you put out a guidance figure and then there's a whopper and you miss, I don't care for that. That's, and to be frank, their guidance, expectations, their update for 2025, it's not terrible. It's not great. They're keeping their revenue expectations the same. This was the old figure of around $11.2 billion in revenue for the year. But they are saying that their earnings for the year is going from around $15 per share to closer to $14.60. 1470, 1480. So there is a bit of a haircut that they're expecting in earnings for this next year. A big part of that is because of tariffs. They're saying, there's effectively a 0.6% hit to their gross margins and even greater, closer to 2% hit to their operating profitability because of tariffs, where they're talking about a 30% incremental tariff from China and roughly 10% on the remaining countries where they source their goods and materials. And that is going to be, an impact to their business. I would say a third key reason why investors are, sort of on pause with this, you have, just to reiterate, you have potentially losing market share in the Americas. You have lowering guidance, which means maybe management shouldn't even be in the business of giving guidance. They should just say, hey, this is, these are our North Stars. These are our metrics. This is what we're going to do, versus this game of missing. That Wall Street really doesn't like that, because it really has a double negative effect of not only do you this is the reason why Buffett very effectively never gave guidance. He would only do things like, I would be very surprised if my insurance float at Berkshire Hathaway would be smaller in the future. He would say things like that. But the downside to this is, one is you disappoint investors, and two, you make it look like you can't trust your numbers, or you can't trust your own control of the business when these types of things happen. Now, admittedly, tariffs aren't really in the CEO's, management's, control, but maybe that means you shouldn't be even putting that guidance in the first place, and instead say, hey, this is our North Star, which is free cash flow per share, and here's our capital allocation strategy. That is what I prefer personally. If you do put out a figure, you got to be hitting it, and clearly they're trying to reset it. A third reason why I think investors are cautious or selling off the stock today is because the inventory. And this is looking at Lululemon's balance sheet. Otherwise, the balance sheet looks very solid with a lot of cash and limited debt sort of set up. So very attractive type of balance sheet. But they are seeing a 20% plus growth in inventory. And that does, you could see from the prior year around 1.3 billion. Now it's closer to 1.7 billion. So it does raise the concern when you see inventory step up by 20% plus, and you're seeing the US market on a fundamental basis, effectively flat. You see consolidated sales up around 7%. Well, that's a big jump in inventory for 7% in growth. So does that mean that, you possibly went a little too far in terms of, putting stuff in your stores, or, filling up, the new types of pants that you're going to put, new types of shirts in your warehouse that you're expecting to sell online, and it's just not moving. And so then you do have this risk of, could you have a gross margin or some sort of write-down hit in the future where they say, yes, items weren't moving to deliver that revenue figure that we were hoping, so we had to lower prices, profits get hit just to sort of drive the revenue. So that's, I would say, the third red flag that investors are looking at is this uptick in inventory that significantly exceeds the underlying sales growth. And so looking at Lululemon, is the stock on sale, seeing that, it's effectively gone nowhere for the past year, been a wild ride. First of all, none of this is financial advice. I'm just sharing my personal take on Lululemon. I do not own any stock in Lulu. Also, recently, Vinu, an unrivaled subscriber, wrote, joining your membership has been one of my best investments, both in terms of value and personal growth. This follows Harish, a premium subscriber, who said, you bring immense value with your non-biased insights and a strong focus on fundamentals. The profits I made from just one of your letters has already covered the premium subscription for several years. If you're looking for compelling ideas, come check out Unrivaled Investing. I've recently purchased 2 new companies in just the last few weeks, one of which actually trades below liquidation value. So that's quite interesting. Would not surprise me if this new purchase gets acquired in the next year or two. We'll see. So looking at, also quick plug, for the month of June, Flash, you can see the link below, leveraging AI to analyze stocks, where, you can now get a report on any company in the world that you're interested in for free, completely for free. So come check that out at the link below. That's leveraging AI. Looking at Lululemon, this is the checklist that I run across all companies. Same checklist: aligned management, compelling valuation, obvious growth potential, no blow-up risks, and a win-win type of setup. I'm going to focus on obvious growth potential for a minute or two, just because this is generally the big driver for investment returns over time. You really have three types of drivers over time. You have the free cash flow that you can get, you have the growth potential, and you have valuation. Looking at Lulu, it's important to sort of size up what's the growth potential. Is it obvious? When you think about it, management would say, yeah, it possibly is obvious. And the examples that they would say is we're expecting to keep taking market share in men's clothes. And if you have, a further uptick there, that could be a secular driver. And then they're also looking to expand internationally. Whereas, let's say the US market is more saturated, internationally is, much more wide open. And so you could, maybe you can continue to have that type of attractive growth like you've seen in the most recent quarter, about 19% international growth. So maybe that all pencils out to, let's say, conservatively 5 to 10% type of growth over time. My concerns is that it is sort of a mixed picture, particularly in the US market. One credit card analyst business, I think it's Earnest, was looking at various different purchases from Alo Yoga. I believe that's a competitor versus Lululemon. And their data, looking at, once again, credit card data, I believe that's anonymized credit card data, showed that once a customer became an Alo Yoga customer, they were then spending more with their products versus Lululemon over the ensuing years. So it does suggest potentially Lululemon is losing share to these niche, maybe greater premium athleisure brands. It's really not my specialty. I don't wear their products. When I use a Google Trends search, I would say it's very mixed. I wouldn't say there's a strong signal that Lululemon's definitely losing market share. I mean, you can see Viore and Alo Yoga. It doesn't really look like they're rapidly taking share, or there's this huge disruption in terms of interest in the United States. But I look at this and say maybe there's signs. I mean, at least the signs that comparable store sales at Lulu was down during the most recent quarter. That's enough of a red flag for me personally, to say, okay, well, what's going on here? Is this just a soft economic environment, or is this, potentially, a more competitive challenges? So I would say from a growth perspective, it's not super obvious to me. So I sort of struggle with that one on the checklist. But if I had to sort of think about it to try to underwrite, how do I think about the growth prospects in the years ahead? Maybe continued 5 to 10% range. And that's in line with what management's guiding to. They're guiding to around that, around 6-7%, level. And so looking at, and this is a hypothetical framework. Of course, stock price can go way higher, way lower. And you could see just the volatility from my last video on Lulu, where at most of the year, calling it out as potentially a juicy bet, worked well for a good chunk of the year. But then today, losing the vast majority of the gains, down another 20% today. And so thinking about, how does this potentially perform, let's say over the next 5+ years for Lulu? So once again, around, single digit type of revenue growth this next year, $11 billion plus, then talking about 20% plus operating margins. So you're really talking about a business trading at a mid to high teens earnings multiple. And so is mid to high teens earnings, is that really enough to be attractive to you as an investor? And then it turns into, okay, so if let's say you're at 20 times, that's the high part of the teens, let's say 20 times. So you're effectively getting a 5% free cash flow yield. So then a 5% free cash flow yield plus, let's say, you get 5% type of growth, then you're talking about, you ballpark around 10% annualized return for an investor. And then the question is, well, what's the multiple 5 years from now? And it wouldn't surprise me, given that sort of growth prospects, 15 times multiple could be at the low end. It doesn't always have to be, premium brand gets the multiple if you have the growth. But if you have signs that you're losing market share, you could have that multiple contraction. So it is possible to see a scenario, let's say over the next 5 years, where Lulu sort of makes a little bit of money, maybe it breaks even, doesn't have a stellar next 5 years based on this current price of around $260. But you could also see a scenario where if growth is closer, they're able to reaccelerate, get back to, let's say, 10% type of growth. Investors, apply some sort of premium versus, where they are today, closer to 25. So then you'd get the fundamental growth and you'd get valuation expansion to, let's say, 25 times. Then you're talking about closer to 150, 200% type of return, because you'd also get the free cash flow the management can return to you via buybacks or potentially dividends, that sort of thing. So I look at this and it's not bad. I would say it's not bad. It's not super compelling. Like when I'm making a new purchase, and I've called out 2 ideas to my subscribers at Unrivaled Investing recently, my low needs to be, at least how I think about adding capital, my low needs to be, let's say, 50%, because my goal is to say what is very likely to happen, where the low case, even management would be disappointed by that. And if you have a setup where even if management's disappointed about a scenario and you're still able to roughly pencil out 50% type of upside, then I think you're looking at something interesting. And so that's how I personally think about, the purchases that I make from my own personal investment journey. But look, some people might look at this and say, well, this is great. It's up to, let's say, 200% type of upside and flat over the next 5 years. That's pretty reasonable. It's not bad. It's just not right for my personal journey. It's not yet at that compelling valuation framework personally. I think if you were to look at closer to $200 per share, unless the macro gets completely worse and, they have to reset their guidance once again for the year, saying, hey, revenue's going to be closer to zero. If everything sort of stays where it is right now, a price closer to, let's say, 200, then I would say it starts juicing it more favorably, where, in that low scenario, with a $200 price, then you are probably talking about closer to that 50% upside in that low scenario with only 5% growth and margin, contraction and they effectively no benefit and no real headwind from valuation. So I hope this video talking about Lululemon, why it's down today, my thoughts on the framework in the years ahead. I hope it's been helpful for you. If so, please make a point of hitting that thumbs up, hit that subscribe button, and also come check out unrivaledinvesting.com. Thanks so much for tuning in.